Hello. Let me tell you right away so that you can know what to expect from this video, what this video is about. This video is for those who want to reduce their expenses on the management fees that they pay if they currently have invested their funds into, let's say, online banking mutual funds. Because there are different platforms or different in different ways that you can purchase. You can do an investment, especially mutual funds or ETFs. You can do it either in online banking, that's the easiest option, but most expensive one. You can do it in some direct investment platform provided by bank. It will be more complicated to set it up, and you'll have to manage yourself on selecting those. It means that you will not get any advice from a bank, but it'll be cheaper. Management fees will be lower. Or you can go to direct broker platform like Interactive Brokers, Questrade, or some other ones. I live in Canada, so there is some limited number of broker firms, and there you can buy something similar, some ETFs or mutual funds that will charge management fees a lot less. And in my particular experience, I found a way to find an alternatives to my online banking mutual funds, and saved and decreased the management expenses up to minus 98%. So if I was paying a specific amount, let's say $100 per month or $1,000 a month, now I pay 98% less. And in this video, I'm not gonna describe or like suggest any specific mutual funds or ETFs to buy and discuss which one are better in terms of like I won't give any suggestions about that. What I'll give in this video, I assume that you will have you already own, like me, some mutual funds that you're happy with, and they're on online banking site. But as I recently found out, I started dig more, and I understood how much does it actually cost for me to have bank managing my funds, and I figured out that I pay a lot, and I want to have. I actually like the performance of these funds, but I just want to pay less for management fees, and I found a way with the help of AI, with a few models and different LLM providers, with a combination of tools, and also with the tools that Interactive Brokers software provides. And with help of those tools combined, I was able to find a lot cheaper alternative in ETFs, in the face of ETFs, in the form of ETFs, and saved minus 98% on management fees. So that's a little bit of introduction. I'll share a little bit of a story how I came here in next couple minutes. If you don't want to listen for that and want to get to a specific point, how do I do this and the details, you can just scroll up. I will set up some bookmarks on YouTube so you can just scroll. But apart from that, I just wanted to say how I came here. And it's a little bit awkward for me, like first time for me, I'm recording a video like that, especially with this picture-in-picture. Whatever I was doing before, if I was doing like some screen sharing, I was just showing the details as well without my picture. So this is new form. I want to try this. I don't know. Let me know if you want to see videos like that, I mean, not me, nothing interesting in me, but in the information that you're going to get from this video, if it's going to be valuable for you, I find it's valuable. And yeah, and please don't judge hard, but any suggestions or kind of kind comments will be appreciated. Um, for me, so let me just tell you a little bit about myself. So I've been living in Canada for 13 years already. As you can hear, I have really bad Russian accent. And I may do some mistakes, like 'cause, normally I speak Russian, but I work as a software developer in a company headquartered in the Silicon Valley in California, and of course I speak English there, so it's improving a little bit. But anyway, I still have a bad accent. And I've been living in Canada for 13 years. Three of first years were actually in French-speaking province in Quebec. So I just have like 10 years of experience speaking English. Um, and so why did I actually start doing this type of research um, and um, started to work on this? So originally I had my investments in a bank, as almost majority of people start. So they have some funds in the bank, and bank says, hey, open our RSP or TFSA or even margin account somewhere and buy our mutual funds on online banking site. And I did so. And I had some investments, and was looking at them. Sometimes they're growing, sometimes they're going backwards, basically kind of decreasing in value. And I didn't know if it's the performance overall good or bad. But then at some point, like maybe 5 years ago, I started thinking about maybe I should start doing investment trading, like, and managing myself. And especially my friends, when they were saying, um, when they're sharing stories that, oh, they bought this stocks, that stocks, and they earned that much. I was kind of excited to hear that, and I thought, well, if they do that, why can't I try? And that experience was actually not good, because I was working as a software developer, and I keep working right now as a software developer full time, basically 40 hours a week. And meanwhile, I was trying to do trading, and eventually, just want to say up front, it appeared to be not good idea trying to combine basically not investment but trading. Trading and investment is, different things. I was trying to do trading, and I even took some paid courses where they were teaching some patterns of the stocks, and yeah, not going into details. I took around like half year of courses, and seriously spending a lot of time on them, and trying to do day trading. And at the same time, so I had my investments split on two parts. So one part was in online banking on mutual funds, and the other part I registered account in the interactive brokers. So basically, full hands-on with lots of tools and details on buying specific stocks, and started doing, I mean, not only stocks, ETFs, index, and options, and so on, and started doing day trading. And at the same time, I was doing my work as a software developer. And of course, so during a day, I was able to allocate a specific amount on time on trading, because I still have to do my work. So it was maybe 1-2 hours a day, and so on. And at the end, it's been like 1 year of trading. Sometimes I was earning, sometimes I was losing, and I couldn't really understand if this is something that I can keep up forever, and eventually I will just become profitable majority of the time, um, or not. But overall, like after 1 year, I understood that I am actually losing money. And um, at the same time, while I was trading, and there was also COVID started at that time, and then COVID ended, and the market went crazy, went up. I started to earn, but then market bounced back, and then started to fall down. If we talk about purchases for long, not for short. So anyway, at the end, I understood that each person has to do whatever he's best on. So I find myself I'm experienced and a good software developer. So I have to concentrate most of my time on software development, but I actually can be a good trader. But in order to be a good trader, you need to spend corresponding amount of time. And that time, especially for first few years, or at least 5 years, you have to be you have to do trading like your full-time work. You have to do 8 hours a day, maybe even more, to research outside of the market. And then maybe after a specific amount of time, you can be successful. Still not guaranteed. Because you have to work in a team of the investors. You have to. It's not only about the experience; it's also about the luck. There is some luck and so on. So I understood that I can't combine software development and day trading, or even just investment, because I at the end I switched from day trading to investment, just buying specific stocks: Tesla, Microsoft, Boeing, Netflix, and so on. And then I was still losing at the end because I didn't know exactly how long to hold, when to sell, and when to buy again, when to enter basically of a deal into the deal, and when to get out. And then I understood that, and then I looked at my online banking mutual funds just as a glance, and I was actually always were doing my trading, and I was comparing. Okay, this is a bullish day. How is my own portfolio, where I buy specific stocks or ETFs, performing, and how is online banking like mutual funds are performing? And I understood, and when I was always looking, I at the end, after 1 and actually 2 years, I made a conclusion that when the market goes up, my portfolio is earning, but it's earning just a little bit. And sometimes it's not even earning because I bought a specific companies, and some companies are doing great, but that specific company that I bought made a bad report, and then they just crushed. And I even lost money. But when I look at the same time on mutual funds, which are in online banking, when the market goes up, they actually go up, and pretty well. Of course, not as good as maybe S&P 500, but very close. When the market goes down, oh, that's crazy. I lose a lot of money. The I don't want to get into specific numbers, but I was losing money badly when the market was bearish. And but when I look at mutual funds, they are either staying even, or they're losing money, but not much, just a little bit. And that was look. I was seeing this situation again and again and again, each day, each month, each quarter, and even like for a few years. And then I understood I have to stop. I have to stop my investment, my um, um, day trading, especially investment into specific companies, and I have to just switch back to online banking, mutual funds. So I wrapped up closed positions. Some of them were in profit, some of them were in loss, cashed them out, and then transferred back to the bank, RBC. And I bought everything on some mutual funds, and the specific mutual funds that were performing quite well. And then for 1 year, I was observing how they perform, and I actually liked. Like at the beginning of the video, I said that I like how they perform. I like my mutual funds, but what I don't like is what I found. I found that I pay a very big MER, management expense ratio, and I was started to think about, is there a way to optimize this? Even though the performance is still good, considering that I still this money, the MER that I pay already deducted, and I'm looking at the performance after they deduct their expenses, management expenses. I was still thinking, why can't I think about optimizing it? And then the option that bank offered me is they said, you can switch to direct investment. We have on RBC direct investment platform, and it'll be much cheaper. But then I thought, if I can switch to direct investment and buy over there, can I go even further and find something even more cheaper than direct investment, like in interactive brokers? Because at the end of the day, these mutual funds, what do they own? They own specific portfolio of stocks. And this mutual fund, like I'll say upfront, is basically trying to mirror the S&P 500. And this mutual funds, if they have specific stocks on mirror S&P 500, why can't I just buy in direct investment some similar ETF that mirrors this mutual funds, or mirrors? We can say if it mirrors S&P 500, then ETFs will mirror S&P 500. And how much it's going to cost me? And I found out that they're like almost 98% cheaper in the expense, in the management expenses, than the mutual funds in the bank. Let me go into details. By the way, this video, this picture and video will stay just on this screen. I think you don't need to see my face so much. So whenever I scroll, I like this feature in my Mac. When you scroll between views, it's so convenient. But unfortunately, my face is not getting sticked into multiple screens, so it's going to stay here. So let me get into details. The mutual funds that I'm talking about is RBC Equity Fund. And this RBC Equity Fund has multiple series. What this series mean? Series mean a specific access rights to the owners, for those who can buy. So Series A is the most expensive Series A that are available only in online banking site. So you basically need nothing, but everybody has an online banking account, right? And it will be available on the online banking side, but look on the MER. This MER is almost 2%, 1.88%. So they charge you almost 2% if you invested like 100,000, if you invested $1 million. And doesn't matter if one of the years or quarters they were performing, they were sorry, they were performing well, like they were bringing money, or they were losing money, your portfolio were going down, they will still keep charging you this MER. Doesn't matter of performance. Of course, they'll try to perform and to perform in the plus, and they probably have some initiatives when they outperform specific criteria, or maybe indexes like S&P 500, benchmark indexes. But anyway, And this, by the way, management fee 1.6% is actually already inside this, inside total MER. So you don't have to sum it up. You just have to look on this MER. And the bank told me, by the way, let me just tell you why I like about these stocks. So they were performing pretty well. Of course, you don't have to look only on specific quarters. Where they did 31%. In the third quarter of 2022, they did even minus 12, almost 13%. But most important is the whole market was down at that time. And it's no matter how much they were losing comparing to the benchmark indexes and so on. But overall performance, where did I look? So this is the U.S. equity funds, so what I normally do is I open the fund facts. So I click here and it opens this PDF, downloads PDF, and it says the industry coverage. So industry coverage is like almost 30% information technology, 15% finances, healthcare, and so on. And we can see right away their portfolio of specific stocks. And we can already start seeing from the top what are the main what's the main content of their portfolio. It's Microsoft, Nvidia, and they even have some funds. So basically mutual funds inside mutual funds, RBC mutual funds, pretty big portion, 5.6%. There is another one also 2.2%. But the most important thing you look at is at this line where it says average return. So average return is around 10.5%. And this return is based on the MER that I pay 1.88%. Because I have Series A. And then I came to the bank and asked, can I pay less? And of course, they said, no, you can't negotiate this MER. But what you can do, this MER also includes, from the banking side, there is a special advisor, investment advisor that gives you, you can buy, I suggest you to buy this mutual fund or that mutual fund because of this, because of that, because of dividends and so on. And he may say many different reasons, and it's up to you to kind of agree or not to that. But they said you can open direct investment account and then consider buying Series D. If we switch to Series D, so the page is going to refresh and it will show different funds code right now, RBF 1022. But this Series D is available only from direct investing account. And this Series D doesn't include, you cannot buy from an online banking site with the suggestions of bank advisors, because it doesn't include bank advisors fee. That's why the MER is actually much lower. We can see MER right away dropped to 1%. And if we download the fund facts from Series D, it will be a similar PDF document. So this is Series A, the old one. This is, let me enlarge a little bit. This is Series D. And then you can see that it is exactly same portfolio. If you compare exactly same portfolio, it's just you will pay less. And if you start looking at that line, average return, somewhere in the bottom, here, average return, you can see right away it increases to 11.5. So 1% up. And why is that? It's because you pay 1% less for MER. The numbers, of course, like not exact because it's like average returns, but still, and you will see it also on the graph. So the best performance for 2024 was 31.5%. That's for Series A, and for Series D, it's already 32.6%. That's good. So I have good option now. Exactly same portfolio manager, so the same guy, Brad, whoever. Um, he'll be managing. It'll be containing exactly same portfolio, so you can compare. Um, but I started thinking further. Can you do even better, but pay less MER if you go to? So this is maximum what you can do at the bank level. Where actually you start doing this is direct investment, they consider as a different corporation or different entity, and it's not even bank anymore. That's a kind of bank related broker. But I started thinking about this, and I didn't know. So I didn't know how can I find some ETF as an alternative. Of course, you can. This is a mutual fund. And I started researching the difference between mutual funds and ETFs. And actually, the best, I don't want to deal, as I said, I don't want to deal with with the direct stock purchases anymore, because you buy some stock, yes, it may perform really well, but then eventually, I don't know, you don't know, you don't have the insights, inside the details of what's happening inside the company, even though they're sharing something, but whatever they share, probably when you heard about this, some news or whatever, probably it's too late to make an action. And eventually, you don't know, but suddenly they can just collapse. They can go bankrupt, or maybe not bankrupt, but they can drop in value dramatically, and you will lose lots of your portfolio funds. So I made a decision for me. So if I want to get back to interactive brokers, to some brokerage platform, I will buy only ETFs or mutual funds. Something that you basically buy some industry or a combination of different industries, which are like in mutual funds. Here we have combination of different industries. And if a portfolio management company, for example, here RBC Global Asset Management is a funds manager, if they have some funds, and let's say Microsoft go bankrupt one day, what's going to happen? It will affect, of course, the performance of funds on 6.7%, but not on 100%, or maybe even there will be some even bigger impact because it will impact some other companies at the same time. But anyway, it's still not going to be 100%. But at the end, what gonna do the fund manager? They will just remove this company from portfolio and will replace with the other company that will be performing better than this company. So at the end, you're not gonna lose all of your money. You're gonna maybe lose a little bit, but the overall portfolio is gonna be kind of keep performing better than if you just had a specific stocks in your own portfolio. So I made a conclusion for myself that I will go either with mutual funds or ETFs. And normally you don't purchase like any mutual funds here on interactive brokers. Mostly you deal with ETFs. So I started to think about I need to find an alternative to this mutual fund that I have on the ETF side. And I started to research internet, and of course I have limited knowledge, and I have to read a lot of documentations and do a lot of comparison. This ETF, what's the portfolio, and what is the management company, what's the performance, and that ETF. So that's very hard work. And I thought, why can't I use artificial intelligence for this? And yeah, I use AI a lot in my company where I work as a software developer, and I actually one of the taking one of the roles that's responsible for integrating it into our business processes. So I know how beneficial it can be to solve specific tasks, and I think tasks like that are actually AI should be very capable of trying to give somewhat good suggestions about this topic. So first thing I asked AI is, where should I start from? What should I start looking at? And AI gave me some suggestions. So first thing it said, check liquidity. Liquidity tells how easy you can buy or sell ETF. It's important. If you buy ETF and at some point you want to sell it, you should be able to sell it, and it should be easy. If you can't sell a specific ETF, it means that it will drop in value dramatically. It means that no one interested, and if no one interested in a specific stock, on a specific ETF or mutual funds, what happens to it? It drops in value. You lose the money. So AI suggested liquidity. It's the first thing to check, and in particular, there is a parameter, or how it's called. Okay, I forgot the word in English, but anyway, so that's let's say parameter. That's called ADV, average daily volume. So that's the first thing to look at. And the other thing is you want to look at the bid and ask spread. So basically, the difference between who is willing to buy and who is willing to sell. And less, so it says the difference between buyers and offering, basically, smaller the spread is, it means higher liquidity, more interest on the market, and so I have to look for smaller spread possible. Then, of course, I need to look at the holdings. Basically, if I understand correctly what it said to me, what are the holdings? Well, that's obvious. So, like here, I look at the holdings, and these holdings actually represent the industry sectors it's covering. So it's important to keep that in mind. Total cost. Yeah, so that's basically the main thing I started thinking about. This is basically the MER, how much it's going to cost for me when I will trust my funds to this ETFs, and this ETF is going to manage my funds, how much they going to charge me for this service. And I look at this, wow, there can be some ETFs, maybe something similar, they charge you 0.03%. So it's not like here, it's not like 1.8, almost 2%. It's not like 1%, but 0.0 something. Wow, I was surprised. I was shocked. And if I can find something like this, it'll be awesome. And going straight forward, I'll tell you, I found something like this, and I'll share with you how. Tracking error. Yeah, how closely ETF matches its index. So most of the ETFs, when they're created, they're actually always they have some role, or they have some target, or let's say, yeah, some purpose, target, or goal. Yeah, some goal. And most of the time, goal of some specific ETF, if you look on ETF, you say, well, it's performing well, it's performing or not well. Of course, you look if it's bringing you money or not bringing you money. That's one way of looking at it. But most accurate way of looking on the ETF, it's performing well or not, is ETF always, they have some goal or comparison index funds like S&P 500, Dow Jones, or something like that. And if ETF is, if you look at its graph and also its numbers, if it's trying to mirror a specific index fund and it's as close as possible, means that the tracking error will be very small. that will mean that it's actually performing really well. Even if they're losing money, if index fund like S&P 500 losing money, it means actually most of the time that the right at the specific time the market is bearish and everybody are losing money. Now, right now, at this point, you just need to accept that and understand. Okay, how much my portfolio is losing comparing to others or index portfolio or index funds, and then if you're very close to them, most of the time that will mean that it's actually not bad. Um, it I may be wrong. I don't know. That's the way I understand. Please correct me. Um, but that's how I look on it. And then the other thing is check the fund size, or there is a specific parameter called assets under management. So that parameter is actually very important. It means that you don't want to buy some ETF that holds, I don't know, a few $1,000s under management, or a few $millions. You want to look at billions. And even like tens or hundreds of $billions in management. It means that lots of people are trusting this ETF. If it manages only the small amount of money, means that probably either it's new company or their performance as well, or they have bad reputations, and not many people or companies or some other funds, because some funds buying ETFs as well, they don't trust. But if they have a lot in management, so it basically says if it's less than 100 million, might be risk of closure, even like that. Well, imagine you invested into ETF and they decide to close. I actually don't know what's going to happen. Are you going to lose your money, or they're um, they're insured somehow, and maybe you can get a portion of it? Not sure, but you never want to get you never want to get to this point. That's why you need to look into this parameter. And of course, you need to look at the performance and the benchmark. Benchmark means that comparing to, like for example, WU funds, VC, S&P 500, ETF. So it says nearly identical and so on. Issue reputation and purpose. Well, yeah, of course, you also want to you want to look at some well-known, or maybe some companies that you have heard about, and they had a good reputation. I've heard about them before, and they had a good reputation, like Vanguard, iShares, which is BlackRock, State Street, BMO. I wouldn't trust BMO much. I don't know. Maybe I'm wrong. I don't even know about this one. This three I heard, and I prefer to deal with at least these companies. So that's the suggestions they gave me. I also was asking, it's actually, I find a good way about dealing with AI. Sometimes it's worthy to ask it in multiple questions. My original language is Russian, so something similar. So look at the volume. Oh yeah, that's actually, well, yeah, that's the first point. The volume, then you look at the spread, then you look at the AUM, assets under management, check. Mhm. Yeah, okay. Well, I will not go into these details. I think that's maybe not, at least I didn't pay much attention. It says check number of market makers and market centers that trade these ETFs, like on the websites ETF.com, Morningstar, Yahoo Finance. Okay, maybe that's a good thing to check, but at this point I ignored it. So that's first thing. And then the other thing, what I did is I actually I did this with the OpenAI GPT model. I have also a Claude paid model, Anthropic Claude paid model, and I found it's This AI LLMs, they're specific LLMs. They're good at specific tasks. For this type of questions, this type of task, I found that OpenAI is better. So I used OpenAI for these questions. But when you start, if you want to do more specific research and start dealing with the data more in more details, I like more working with the Claude Anthropic AI. In specific case, I used the model, I think Opus 4.1. Anyway, so what did I do here? I submitted the PDF, one of the fun facts. I think I did this, the Series A. At this point, it doesn't matter which series you provide as an input to AI, because mostly AI is looking at the industry sectors and top investments. Maybe it'll be looking a little bit deeper and find more, because this is just 40% of investments. And of course, it'll be good to look at the full list, try to match it, because like I said, I was happy with this mutual funds. Its performance was actually, for me, was good. Someone may think, oh, this previous year they did only 32%. That's way too low. I want like 50 or 60%. Well, go play lottery then. I don't know, or maybe try to. Many people will say, I bought specific stocks like Nvidia, I bought Tesla, I bought some other stocks, and I earned 400%. This type of stories I heard at the very beginning of my path, and they made me excited and maybe anxious, and that's why I started doing trading and started doing like started invest money into learning trading and doing some courses and so on. But they're not realistic. I find it's again becomes like a lottery, unless you take a proper education, you spend adequate amount of time for learning, and while learning and trading and experiments, you will be losing money first few years. But I didn't have that time. I didn't have that luxury, so. I had to do my work as a full-time employee on the other domain and trying to find time for investments 1-2 hours a day. That will not work. So for me, I was happy with these funds, and I said to AI, find a list of 5 best matching ETFs, make them in order, best basically on top, and then going down. The mutual funds PDF attached, so the details attached. So first thing, what does AI makes it? Basically reads the PDFs and extracts information, the key point from it. So it said this is the, okay. Oh, okay, so it says details about this document, and again extracted from this PDF, the summary, most important information related to my question. So the focus investment, equity, securities of U.S. companies. Yeah, that's why it's called U.S. equity. Top holdings, as we saw before in the document. Sector allocation, also the same thing. Risk level, medium. Fund type, broad U.S. equity funds, and MER. Yeah, so then it makes a summary that it's a diversified U.S. equity fund, blah, blah, blah. And yeah, and then it says what it's going to do. It will analyze these funds, search best matching ETFs, and so key things that it'll be looking for: U.S. equity exposure, 30% of technical allocation, large capitalization, bias, and some mid capitalization, top holdings, mega cap technology, and let's find some ETFs. So now it started doing some search results, like a web search results. We don't need to go into detail. So let's go into the results. So it found few companies, few ETFs. First one was VTI by Vanguard, and it gave it details. So now, basically, what did it do? It returned 5 ETFs: VTI, VU, the SCHG, VUG, and SPY, 5 ETFs. And now what do I do with this data? I can just fully trust, I have few options. I can fully trust this, the results, artificial intelligent results, and just get the company from the top of the list, the VTI, and sell all my funds on the RBC side, move it to interactive brokers, and buy everything here with this ETF. Or I can maybe do some more analysis. And here we get into interactive brokers. So what tools do they have? So first of all, I created a new tab here on that portion of the screen where you can put, I created, I have actually my portfolio on the RBC consists of multiple mutual funds, but majority, a big portion of the portfolio is we're taking by this US equity, that's RBF 263, the one that I was showing with the Series A. This is RBF 263. And there are a bunch of other ETFs which I'll be doing the research. I already started, like international equity, mutual funds, starting search alternatives. But right now, same principle I'm gonna be using for those. But for now, just for purpose of this video, show you overall the strategy that I'm using. So you already have seen some part of it. Now the second part of this. So I did put this ETFs into that category. So I created a category that I can drag and drop, and started comparing them. I also have, as the AI suggested here, what to look at, because one thing when AI suggests you a specific ETFs and you can just read this information, say, wow, awesome, 0.03% for MER, for expense ratio. That's like comparing to RBC. That's a lot. And by the way, where did I get this? At the beginning of the video, I said, well, some funds may save you up to 98%. So 0.3, let's engage the calculator in the Mac. You divide by 1.88%. So this is what you will end up paying. You will be paying zero. The difference. Basically, that's the portion. I would say. Let's calculate the difference. So I'll put it into parentheses and -1, which minus 100%. So at the end, you see, you will get, let's multiply by 100. So at the end, it comes up, you will be paying minus 98% if you switch from 1.88% of MER to 0.3%. That's crazy. That's like almost free. You will be getting similar. You will be getting similar performance like this, but this performance will be even higher. So if we saw here, performance was like this originally. Now in the direct investment on RBC side, it will be even better because you'll pay less on MER. And you can imagine how much better if you find ETF that's going to mirror this ETF, uh, it'll be much better. Okay, now I am just coming back in circle. So now let's go further. So what do I do with this data that I got from the Claude AI? I put it here, and then now I need to come back to this, to suggestions, original suggestions, and start looking by myself, not just like what it highlighted here for each ETF, but by myself, start looking and comparing those on these key factors. And in order to do that in interactive brokers, if you want, please let me know. I can share to you the process, how to create account on interactive brokers and how to move your funds, how to transfer it, how to complete the documents. It's quite complicated, but you do it one time. And I actually set up here the advisor in interactive brokers, an advisor account that's like an umbrella. And I have a few funds in RRSP, few funds in TFSA, few funds in the margin account. My wife has similar investments spread into multiple accounts, but I merged all these funds under one umbrella advisor, a family advisor account, and I can manage all these funds together. And there is a process how to set up. Let me know. I can make a video about this. But for now, it's like that. And now I set up all these fonts. And whenever you put some font here, so you put Woo, press enter, it asks you what probably under this symbol there are multiple versions of um, um, securities you can select here. And what we need to look at the Vanguard, we need to look at its ETF, and you need to look at the specific, I believe that's a stock exchange. This one is located in USA, United States. This one is located in Mexico. And don't choose options because you don't want to. At this stage, you just want pure ETFs. So for ETFs, you just choose stock, but it's actually ETF. And same thing, for example, for SPY. SPY is the index it's one of the most famous indexes that mirrors very closely S&P 500. Sorry, that's ETF that mirrors the index S&P 500. And here again, you have option stock in ARCA, stock in Mexican probably exchange, stock in some other exchange. I don't know what is ASX. Anyway, I would choose this. Yeah, just coming back. So the S&P 500. This is performance for 5 years. So if you look SPY. 5 years. So it'll be something very close and similar. I'm not sure if I think probably you can buy index fund, like I mean S&P 500 directly. Anyway, let's not get into this. What I don't know is I don't know. Maybe I should have researched that. But so you put all this data in, but now you need to set up the columns in order to display information that's valuable for you, the information that the AI is suggested to look at. In current case, OpenAI ChatGPT. Because by default, it will be just showing the last, which means the last price when it was traded, the change that was like change in the amount and change in the percentage of that stock, if it gained on the last trading session or lost, and that's it. And then you need to start adding stuff. So the way to do it is just you right click on this, you go manage columns. And here I have already added all the ones that I wanted, but you can start searching for columns. So you just look for spread. Okay, yeah. So it doesn't find spread on the right side because I already added it. here. But if it's not added, in your case, it wouldn't be added if you started originally from the beginning. So you will select it and then you click add. So something like, for example, here, if you add news, you see when I highlight it, you click add, and then it will move to the left side. So, and then you do something like this. So you do volume, and then volume you have, so first you have few categories here. That's history, the options. You don't want to look at the options, auctions, fundamentals, maybe you want to look, but here there was average volume, the one that they were talking about, his average daily volume. And if you hover over that's what it's exactly saying. It's saying the average daily trading volume over 90 days. So that's the one that you want to add. What else? Spread we already did. Holding liquidity, you can't check in the columns. I'll show you the other tool with Interactive Broker that you can check on. The expense ratio, that one you can add, and I'll show you. This one is, so yeah, the expense. So you just straightforward, you type here expense, and then you will find there'll be a category called ETF here, and it will show you expense. So that's what it says, annual expense ratio in basis points. Basis points means that it'll be showing you number multiplied by 100%, so which means that if it's 0.03%, multiple 100, it'll be 3. So you will be looking at like basis points in the form of basis points. Then what assets under management, also straightforward. So here I put the assets under management on the right side, found it. And if we hover, that's what it says, assets under management, straightforward. Bid and ask, oh yeah, by the way, with the spread, you have two values. This value is spread in a dollar value, basically, yeah. So if they buy on $100 and sell on $98, 100 minus 98 will be $2 difference. But this one, bid and ask spread in percentage, so here is going to be 2%. Straightforward. I think it's useful to see both. And sometimes this tool is actually showing one version, but doesn't show the other one. It shows this value, doesn't show this, or vice versa. So you want to have both. Okay, so these columns that I did set up, and let's start looking at them. So let's start with the S&P 500. S&P 500, we hover over, we highlight this. And with Interactive Brokers, the way it works is that it has multiple tools here and there, and they have this link icon, like green icon. This green icon means that all these portions of the screens that you see here and there, they're all connected depending on which security you currently highlighted. So if you highlighted S&P 5 SPY, now everywhere will be SPY. So if I click here, WOO, now you see here it changed to WOO, here it changed to WOO, and the graph is for WOO. The news section also for WOO. This one is for WOO. We go to the other screen also for WOO, very convenient. This one is a little bit different. This is mutual fund replicator. That's another awesome tool I will show you. But it'll be also, I think it should be also connected, but if it's not, it's okay. We can always put value here manually. So I selected S&P 500. This is the graph. Okay, let me move my face away. Okay, I think this area we don't need. I don't want to close this. My appearance, I think it's kind of a little bit cool. Have it anyway. Let's see. That's the first video I'm doing, but yeah, like this. Interesting. So first of all, you want to look at the. Let's go one by one. So they say liquidity, average daily volume. Average daily volume, you see here, okay, S&P 500. Average daily volume, it says 29 million per day, which is, well, S&P 5, SPY is one of the kind of benchmarks. So I would say normally I look at it as the um, as a something, as ethanol, or as an example. So we can consider that that's a lot. Like 30 million daily means that. So this ticks that we see on the graph are daily bars, and it means that during a day they. I'm actually not sure about this. Correct me or suggest me about this. So here it says that 29, or let's say 30 million, rounded up. And then here and down below the graph, you can see another chart that shows you the volume. And on the right side, we can see that above, this is a 50 million. And for that day, for the last day, it was actually, let me just go a little bit up ahead. So with this fundamental explorer SPY, it is showing you here the average 5-year average volume, which is 29.2 million, which matches this 29.2. Now we know this column where it gets data from. But then at the same time, it shows that today means that the last trading session, the average volume was almost 90 million. Okay, 90 million, that's a lot. Considering that like a 5-year average was around 30, means that some days it was trading more than 30, some days even less, but on average for 5 years, 30 million. But if we look on this graph, which is a little bit confusing for me, but I still find it's very informative, and I like to keep it, because here it says like 50 million, a little bit more, so we can say, well, 55 million. And actually, last trading sessions showed almost 90 million, which should be around here. But why it's not here? What I think probably because this in this session they lost the money, it was in red, so it opened higher, but closed below what they opened. They probably consider here the volume, the sale volume, not the purchase volume. I mean, and that's why it's lower than 90%. But anyway, still informative and still a lot. So I look at this parameter. Let me move this screen here because I don't want to be switching between one and the other screen. So we look at this parameter, we put a check mark. That one is good. And yeah, so that one is good. That's why in that group, this is the group of securities I put on top. So that's one of the best matching ETF based on this parameter. Then we look at the other parameter, bid and ask spread. It should be as small as possible. What is the spread? For S&P 500, the spread is 0.07. So that's the difference. And it in the percentage value, it's 0.15%. Good? I think it's very good. Very small spread. Comparing to others, to the other ones I saw, I find it's very good. We put a check mark for this, green light. Then the other one, holdings liquidity. Where we can see the holdings. And of course, we don't want to look at the liquidity into each holding stocks, but overall, with this parameter, I'll just assume, let's look at the holdings, basically what they have. And if you look at some company and you find NVIDIA, do they have good liquidity? Of course they do. I heard the capitalization of Nvidia is above the GDP of. There are only two countries. Just recently, I saw a tweet. There are only two countries in the world whose GDP is higher Nvidia's market capitalization, and these two countries are United States and China. All other countries' GDP is below that. So obviously they have they have huge liquidity. We should not worry about it. Microsoft, kind of similar thing, of course. More probably market capitalization is less, but again, these are giants, large cap um, securities. Apple, Amazon, Meta, Broadcom, and so on. So we look at this. Um, our portfolio, so now we start comparing different parameters. Our portfolio, our mutual funds is US equity fund. So we were concentrating, we were kind of targeting mostly US equities. Is this, we look at this data, and is this ETF also US? 97% US, Ireland 1.3, and blah, 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 so on. So can we say that it's mostly US equity? Yes, we can. Okay. Then look, we industry sectors, technology with information technology, consumer, whatever. Yeah, I don't even know this word in English. But financial, healthcare, industrials, and so on. Is it kind of close to this industry sectors? I would say yes. Then, okay, so we're good with the holdings. So the holdings and industry sectors pretty close. Of course, I have to say that in mutual funds on RBC side, they also have Microsoft, Nvidia, Apple, Alphabet. So this is basically Google, Amazon, Meta, Broadcom, similar companies we saw in SPY, but they also have this funds and RBC because they just want to invest into their owner and basically earn management fees on that. I don't think I don't think I want this to be in my portfolio. I don't believe they're actually pulling up, but maybe dragging down a little in some cases. So I'm actually happy that we don't have this in the SPY. That's good. So that's small kind of disclaimer. And then next thing, the evaluate basically the cost of this ETF. Okay, so again, the mutual funds ETF was 1.88. So let's look at SPY and the cost, where we can see the cost. Cost is here. This is the expense ratio, annual expense ratio in basis points. It's 9.45. If we convert into percentage, it'll be 0.0945, blah, 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 and so on. Or we can see a same thing in this tab, profile and fees. So that's going to show up. They round it up 0.09. Is it good? Is it better than all this mutual funds, even Series D? 1 point. So it's basically more than 10 times higher, right? Yeah. So is it good? Yeah, it's good. 0.9. Can we get better? I would say straight ahead, yes, we can, but there are some pros and cons. So still good, confirmed. We like it. Then the other parameter we're looking at, check on basically assets under management. How do they own more than 100 million in management? Or they say it'll be a healthy ETF if it owns more than 50 million in management. We can look at this on that parameter. This one is assets under management, and at S&P 500 it shows 686 billion. So it's definitely a giant. lots of people, funds, and companies trust this ETF. So approved again. Or we can find this information in the overview section. Here's a total net assets, same or similar number, basically just depends on what data you're looking at. Okay, this one is approved. Then check performance and benchmarks. So for performance and benchmarks, so let me go straight ahead to this tab, performance tab. This performance tab showing the graph. We just compare the graph visually a little bit with this SPY stock. We want S&P 500 to this one, for example, like that. But of course, never make a decision just visually comparing something like that. It will be very stupid, even though maybe good decision, but bad approach. Looking this graph, looking something like this graph, or even this graph. Also, if you just make like 5 years like that, no. We need to look on numbers. And if we look on numbers in this Fundamental Explorer, there are two type of charts, or not, the tables I'm looking at. One is cumulative performance and then annualized performance. Cumulative performance means that like if you owned it for 1 day, maybe if you invested $100,000, you will get 0.7%. 1 week give you this, 1 month this. Well, right now is the bullish market. Of course, lastly it was earning really good. Even year to date, starting from the beginning of the year, 14% for the whole year, like month to month or day to day, even 17%, 3 years. That's combined interest for all that time, not just like annual. But for 3 years, you would just get your funds will just double, almost double for 3 years. If 5 years, more than a double. In 10 years, it'll be 3 times more than what you invested. That's kind of interesting thing to see. Like if I was 10 years ago and I put like 100,000, which I didn't have, that's how much, like 3 times more I would have. But most important thing is annualized performance, means that it's average performance for the whole year and only 1 year. So within last 1 year, it did more than 17%. Within last 3 years, on average, it was doing 24, almost 25% per each year. For 5 years, it was doing, because we also include here a COVID time and some ups and downs, bearish and bullish times. So on average, it was doing still very good 16%. For average for 10 years, that does not include the 2008 banking crisis, of course, yes. But anyway, 15 years, 15%. So you look at these numbers, are you satisfied? I actually like these numbers quite good. It's basically now kind of up to you if and up to your ambitions if you're satisfied with this type of return or not. Okay, and how you compare with S&P 500. So that's another thing. Let me just skip this because that's next thing I'll show you, another tool. Let me just complete all these steps, and then it says issuer reputation and the purpose. So it says Vanguard. Like I said, I would trust like this three, at least these 3 issuers. Of course, there are more issuers that I would trust, but for given example, let's just consider those. And we again come back to the overview, or not, it's not overview. Okay, here, the funds management company. So that's right away showing State Street Advisor, which is this. Yeah. So would you trust it? Yes, especially considering total net assets that they have, how many people trust it. Well, the other thing I would look on this fundamental explorer as well is the analysis rating. If you, I would select here United States. And overall, you want to see as many fives as possible. Sometimes it's acceptable to have fours, but you don't want to see like threes and twos and so on. I think it will be a little bit for me, a little bit awkward when I see this type of like awkward dealing with this ETF. I'll show you the example where it shows on one ETF, it shows pretty good numbers, but when I look at the analysis rating, I don't know, help me with suggestions. Maybe I'm too anxious about it and I should not, but that's what I would, for me, my first impression, not to deal with this type of ETF. And it's pretty kind of self-explanatory, the table rows and columns. The holdings we checked, these fundamentals, frankly speaking, there's so many parameters. I don't know about this. Same thing for this. Dividends. I prefer to deal with ETFs that pay around, either don't pay dividends or pay small dividends. And for me, acceptable kind of benchmark, a threshold for the dividend is around 1%. If they pay like 7 or 10% or something like that, that's a little bit of red flag. I prefer money to stay in the security and keep working rather than people trying to withdraw the money and take out of the security. So around 1%, good. What this number, payout ratio, I actually don't care. Impact also doesn't, for at least for me, I don't look at this. Ownership, just a little bit interesting to see the ownership, the institutions, and then the other owners on the just like a ratio, how much the institutions and other owners have it. But I don't go much into details. Just interesting to see what are the other institutions or owners have, like JP Morgan, this one, Goldman Sachs, and so on. So Wealth Cargo. So you look at this company, you thought if they decided to purchase this, considering all other factors, I start thinking maybe it is not a bad idea to do that. Yeah, I think that's it. What I look here, and oh, the other thing I think I was looking at. Um, no, maybe I'll make another video about this. I don't want to go into details about risk and statistics, but yeah, for now I'll just skip it. The bid and ask, you can see that the spread is very small. Now let's get back to the thing that I postponed, is comparing this to S&P 500. So when I choose S&P 500 here for the first time, then Interactive Brokers platform just popped up some window and saying, hey, you know what? S&P 500 is charging you 0.0, basically 9.5 basis points. But you know what? There are some ETFs that performance-wise or other parameters are pretty close to SPY, but they charge you much less. And what right now it's not popping up because I already have it here. But if I do it for the first time, then this mutual fund and ETF replicator window is going to show up. And in this screen, you will see very interesting information. So I don't know why it's not putting SPY here, but I'll just put it manually. Doesn't hurt. Or should I type it in? Enter or search. Come on. If I choose the other one is selected. Come on. Maybe with this, but I'm on. Too bad. I wanted to show you that tool is actually a really good tool. Okay, what if I switch to something else? Scroll back. That's different. So it is loading information, but only some. Okay, let me try something risky. This interactive brokers, their software is a little bit. It definitely has some bugs, but I still like using it because it has so much useful tools. I hope I don't have to, and each time it pops up a bug, I have to restart it. So if I hope I don't have to do that. No, I'll not have to, it will not like freeze. So I'll close this. And there's other ways, so you can right click on it and then analysis tools. So that's Fundamental Explorer that we launched. There's a mutual fund replicator. Okay. Um, Luckily, I did the screenshot. Okay, I will continue from the screenshot. Let me just put this still on its place. It's on my other screen on the laptop. Please hold on. Oh, okay. Here it is. Okay, and I made another video with this, so I put it on pause. I'll show you here. So this how mutual funds replicator looks like, and currently the SPY index was put in as an input, and it tries to find when you click search or you click enter, it tries to find some similar performance-wise analysis, and performance-wise, it's considering multiple factors, and then some performance-wise ETFs that will be cheaper in price. This one, as it states, it compares. This is the resulted table, and it says 15 SPY shares if you invested $10,000, and they'll be giving you 18% of return, and their cost will be 9.5 basis points. And yeah, the rest we don't look. So there is a similar shares called Woo shares. And Woo shares, they also have pretty good funds in management, 760 billion. They also, the type is equity. Their holdings managed by Vanguard, and their return is their first year performance is going to be similar, but their annual expense ratio is going to be two times, more than two times cheaper. It's going to be only 3 basis points. It also provides, so the same information shown here in the form of cards. So first card represents the second value in this table. And here they also kind of show you graph, maybe not the best way to compare graphs, so they're very close to each other. And you can see they're almost identical in the graph. But in the form of cards, so they say you can either get one, you can get as an alternative a WU ETF, or you can get some compound of ETFs, like few ETFs, WU plus a WTI. And what information do I get from here is that good alternative for SPY, cheaper alternative can be WU and VTI. So that just tells me that I may consider them as well separately. And I should do the same comparison that I did with SPY for this ETFs as well. So that's the main purpose. And that's what I would do. Will that work this time? Okay, but most likely, well, right now it's a weekend and we are outside of trading hours. Maybe that's why it's not working. Normally, what it's going to show, like if you select something here, yeah, it's not getting selected. Um, Normally, if it doesn't find the replication, the alternatives, it will just say nothing found, no alternatives found. But if it's going to find, then you will see what you saw before. Yeah, you can go from there. So having that information, I have inserted WU. And on the other hand, I also just came back WU. Oh, I saw this symbol somewhere. And where did I see this symbol? Is, let me just switch back to Claude again. So that was actually in that screen, it was actually recommending, as far as I remember, WU, which was the second ETF, and also VTI. So that's actually another point to the fact that maybe I should consider more about these two ETFs. So when we look at WU, so let's do exactly the same analysis, but this time much quicker. So we look at the funds. Well, we look at the management assets. It's less than SPY, but still a lot, 473 billion. Then we look at the average volume. Average volume is like 10 times less than SPY, but still trading almost 3 million per day. That's a lot. And then we start looking at this again, at this graph, like a volume, and it's pretty consistent. Here it's actually, if we look at the funds fundamental, it will show on average it's 3 million, but today last trading session it did 7 million. So again, this last trading session is showing a little bit more than what we see on the graph, with the same reason, I assume, but around 5 million per day, that's pretty good. So that, again, red flag, green flag. Then we look at the spread. Spread for this specific ETF is actually made me wonder why it's like that, because it's showing a pretty substantial difference between SPY, which is 0.07, and like in the actual difference, like a dollar value. And here it's like 100 times more or something like that, or obviously less, but anyway, a lot more, 1.4. But I think there is a mistake over here with this parameter. That's why I said it is good to have two parameters, the spread and then the spread percentage. which basically shows same information in just in different way. This is in the raw value, this is in the percentage. And if we compare the percentage, then makes me understand and go ahead with the further points. 15% is 0.15% is not far from 0.17%. So I say green flag on this, on the spread. Then we come here and we look on the objectives. We're looking for equity. Yes, it's 99% equity. We look on the capitalization. So capitalization, we already discussed that. Yeah, 700. That's actually interesting. Here it shows market cap 762. That's much more than 473. Still, what I need to know, is it sufficient? Even this number is sufficient. I don't think there is error here. It's just discrepancy in the dates they collect this information. Of course, we can go to Google and then type this, like, I don't know, like Woo stock, and go to this details and start to getting more information about market capitalization and so on. I'm pretty sure I'll be again satisfied with the with that parameter number. So we put check mark on this and go further. Then next, what were we looking for? The spread. So again here, actually maybe last trading session was assuming that the spread was 1.4 or something. I think it's okay because that percentage probably is showing the overall, maybe for, what does it say? For last, maybe it's saying for some last average information for a few days. That one for just last sessions. That's how it's ended. Okay. And then objectives, performance-wise, benchmark index, S&P 500. So that's the objective. We are good. That's what we want. Geographical location, United States. So we remember wanted U.S. equity. So that's U.S. equity. Benchmark S&P 500. Expense ratio 0.03. Is it good? It's good. Is it better than SPY in terms of expense ratio? Of course, it's much better. Well, let's look at the performance now. Analysis rating. Again, like I said, we wanted to see the numbers 5s and 4s, which we mostly see. Chile, United States will be even better. Just 1 4, the rest are 5s. Performance-wise. So that's cumulative performance. Looks something similar. Remember, SPY was also 10 years around 300 plus something. But then we started looking at the now everything. So SPY became like a benchmark for me. And then now I start comparing everything with the SPY. If I find any fund better than SPY in terms of multiple parameters, that will become benchmark for me. But for now, SPY is kind of one of the best. So 1 year 17, 3 year 24, 5 year. So that's another thing to take a look. You can look precisely in numbers and look at the SPY. Maybe SPY will be a little bit better in some numbers, maybe a little bit worse. But then you will start looking at the. I'm actually not sure. Are these numbers considering that this management radio is already extracted from that performance? I think yes, most likely. Let's make just a comparison. So we make this comparison, put it here. Okay. And now I'm just curious. I'm doing that with you as well. performance coming here. Let's compare the numbers. So 1748, 2497 for 3 years. So that one actually did better, and also did better on 1 year. For 5 year, 1636. Well, it depends how much money you invest. If you invest like 100,000, that will come up to a specific amount. So that's basically. So if we take 48 and 56, what's the difference for 1 year? The difference will be 8, right? So it will be, let's say, if you have $100,000 invested and you multiply 0.08, so that's the difference. So $8,000 in difference. $8,000, $8,000 in difference. If you had this ETF, if you had WU ETF comparing to this WU ETF comparing to SPY ETF for 1 year, is it a good difference for you? And for 100,000, maybe you have 1 million, maybe you have 10 million that you want to invest. So that's the question that you want to do, considering other factors as well. But overall, looks this WU ETF is actually that's the one that was suggested by mutual fund and ETF Replicator by Intelligent, and that's the one that was suggested by Claude, by Claude LOM here as the second one. Okay, so performance-wise, all the parameters are better. Yeah, even the 10-year is 1526. This one 1520. Okay, so that's the one that we're looking. Holdings will be pretty much similar to SPY. And you again want to compare because originally, remember, you said, I like this mutual funds. I want to find something similar. So you start comparing this portfolio holdings and industry sectors to this one. And if you're good enough, because you not only consider the performance, you consider the risks, you consider probably the impact. Maybe you don't want to invest into specific sectors, I don't know, for warmongers or something like that. It's really up to you. So that's the things you may consider. But the top kind of key things, this is US and this equity fund. So is this equity fund? Yes. Is this US? 97.73, we can say yes, also US country in terms of country allocation and so on. Okay, we skip this. Dividends, again, remember we were looking for not more than 1% impact. Then ownership, just curious to see. I need to kind of maybe look more into this, and kind of similar Wealth Cargo, JP Morgan, Goldman Sachs, and so on. Same companies that own SPY. They own, oh, that's SPY. I'm sorry. I had to choose to. So once again, performance we already checked. Holdings, yeah, pretty similar. United States, 97%. Dividends should be around 1%. Yeah, there was SPY was 1.07. This one 1.08. Ownership. We don't have information about ownership. That's okay. And yeah, that's it about this. Now, of course, you would say the next thing we want to check is VTI. Let's look at the VTI. Now we go faster. Let's go just from left to right. Average volume is less than WU, 1.6 million. Look at the graph. Look over here. So last trading session, remember WU did 7 million. This one did 4 million. Average 1.6. Still sufficient? Well, they say yes. If it's between 100 and million, it's a decent liquidity. We have 1.6 million. Green mark on this. Under management, 450 billion, good. Spread 0.4, 31%, still good. I think anything kind of around 1, 2, 3%, still good. We don't plan to kind of, it's not day trading. You don't plan to buy and sell, buy and sell. You do investments. The difference, between trading and investment is trading, you constantly buy, sell, buy, sell. With investment, you just buy, or whatever, you sell if you go short, and then you forgot about it, just monitor time after time. But what you want to know is that it's not too big, the spread, because it will affect the price and so on. But looking at the capitalization, which is another thing. Sorry, the total managed assets, 500 billion. Here it shows 450 billion, still very good. And we'll look at the other things. US equity, yes, US. Now the fund's benchmark is a little bit different, which is okay. Because we will be still looking at the performance. Frankly speaking, I don't know the details about it, but we will be looking at the performance further, because at the end of the day, benchmark is good to know, but most important thing is other parameters as well. The expense ratio is 3 basis points. That's awesome. That's one of the cheapest ones, same as Woo. We'll look here. Fund management company, Vanguard. We trust it, or trustworthy name? Yes, it is. Analysis rating. Now we start seeing more fours here, which is okay for now. At least we don't see threes, and still a lot of fives. Then we go performance-wise and start, like we have here, Woo. 1736, 24.9. I'm just comparing here. 1566 here, 16. 1466 for 10, 15. So performance-wise, Woo looks better, right? A little bit. Numbers are still very good, but it looks better. Cost-wise, same. That's why Woo here still staying on top. Okay, go further. Holdings, almost similar holdings. Is it US equity? Yes, US, still 97% is the US. Industry sectors, same. Dividends should be around 1%, a little bit higher. Still not too high, but kind of reddish flag. Still green flag, but start to getting a little bit closer to red. Impact. I also need to spend more time trying to understand these numbers, but I guess the impact is actually not too important. Like if you're too picky and if you don't want to invest into specific sectors, maybe that's a thing to consider. Ownership, something similar. Okay, so overall, what we can say, I would say Woo is very close to VTI, but it's better. VTI is cheaper than SPY for sure. But performance-wise, well, right now the Woo is the winner, I would say. Let's go to the other one that we found. This one. This Schwab, managed by Charles Schwab, or I don't know. Tell me if I mispronounce it. Their expense ratio is 4 basis points, United States, and now benchmark is actually Dow Jones large cap. That's interesting. That's one of the interesting alternatives to consider. And we can consider now it's 50 billion under management. So it is much less than SPY. But if we again come back to to suggestions from GPT, it said, where did it say? Holdings. It didn't give any specific number, but I think it was giving the number here. Yeah, so it says actually uh, it needs to have a good volume, and if it's more than 1 billion, then it's considered like a good a big volume. So that's why when I look at this number and I see 50 billion, it's like 10 times less than all other ones. I still find it's okay because it's still a lot. So I would say a good green flag on this. Um, so we checked this. Now let's check the spread. The spread is, so we got a little bit of kind of flag here. Now spread is also 3%. I don't know why it's because the cost of the stock. That's why this spread in a dollar value is not too informative because kind of see it's showing one of the smallest spread, 0 points, basically 3 cents. But then if you consider the ETF price is only $33, and in percentage wise, it comes to 3%, which is much bigger than all other alternatives. So kind of a little bit of another flag. Then you look at the average volume, the liquidity is around 10 million. Let's look at this number. So average 5 million. Last trading session, it's pretty good volume, good liquidity. Green flag on this. Then we start looking at the performance. Good thing actually I did the screenshot. I can even make it a bit higher like this. So we start comparing. Wow, look at this number. So performance-wise, for 1 year, it did almost 23% for three, comparing to 17 on the right side. 32% for 3 years. For 5 years, 17%. Now it's getting closer. For 10 year, 18%. Here still 15. So performance-wise, you look and you see, well, you get actually surprised and shocked. That's a pretty good performance. Well, that's why you start wondering. Holdings. Holdings at the top looks around the same, but then here you start seeing some other companies, and they invest a lot more in technology, and like 65% technology and less to the other sectors. I don't know. It's like remember at the COVID time, technology was booming like crazy, and at that time they were doing probably um, a lot of investment into that sector. But imagine if at one day um, it's going to bounce back, like this specific sector. Do you want to invest like 65% of your investments, at least in this portfolio, into technology only? That's up to you. Um, for me, I find it a little bit risky, even though I'm fully tech guy, software developer, and a bunch of things, technologies, and so on. I'm fully all in into this. At my personal opinion, I don't know. It's a little bit another flag, small flag for me. U.S. equity 98%. Yes, 90. That's good. Let's look at dividends. Wow, that one. It looks very good. 0 point less than 1%, much less than 1%. Good. Ownership. We don't have information. So that's what it is. Um, because of few flags that I found before, I put it here in the position from SPY, from the benchmark. I would put it into third position still. Then we look further, SPYG. What is SPYG? SPYG is basically um, the ETF that also tries to mirror S&P 500, but it's more like a growth index, more looking at the performance-wise of a large capitalization growth segment of US equity. That's basically straightforward here. So let's look at numbers. The average volume, 2%. So I mean the volume last session, 2 million. 5-year average, 2.5 million. Good. Uh, uh, Total assets, 43 billion. The previous one was around 50 billion. Acceptable? Yes, acceptable. A little bit of a flag? Probably, yeah, I would say. Profile. SSGAs, that's the same company, what was Street, whatever. So that's another way they call it, as far as I understand. So the company trustworthy? Yes. Geographical focus, United States, yes, we are looking for US equity, benchmark S&P 500, then expense ratio 0.04%, good, yeah, a little bit higher than WU, but still. Rating analysis, so that's the one that I wanted to show. Yeah, when you start seeing like 3, 3, 2, and that's for, oh, okay, let me switch to United States. Now you see this number, total return, consistent return, preservation, and so on. So that's kind of a bigger flag for me, bigger red flag for me. Another thing to start considering when you make a final decision. Performance, interesting to see the performance. Wow, the numbers again. But at the end of the day, you wanna kind of make money at the end of the day, right? And you think like I should look at the performance only. You see these numbers? Well, they're definitely like just with a glance of the with one glance you can see they are higher than these numbers. Yeah, well, this is a good green. This is a good green path. VC peers is comparing to the other ones, like alternative funds. Um, yeah, means that some funds did even better than this. Okay, well, that's probably that one, the previous one. Okay, well, still, I put the green on the performance. Industry allocation, again, technology a lot, more than 60%. The kind of this is top 10 holdings. Of course, there are much more holdings, but still. United States, 98%. A spread, we can see the spread from here, pretty small. 0 point, basically around 1%. Okay. Dividends, we want to see less than 1% or about 1%. It's definitely less. Good. Ownership, we just check out of curiosity. Okay. So that's the other one. Well, yeah, but let's make a final decision. I put it here like at the almost at the end is because, like I mentioned, because of this, because of this fours, threes, and twos. They make me anxious, and maybe I need to research more about this. Let me know if you have extra information. One of my friends, investors, recommended me to consider this fund. It's actually traded in Toronto Stock Exchange. Um, and well, I just want to say one of the ETFs that you definitely, I don't know, one of the ETFs that I looked at, I said, why did you recommend it to me? I would definitely, at least based on my understanding or current understanding, and the parameters that I'm looking at, it doesn't pass. So we look at the volume. So at last trading session, it actually did around 300 Ks only, not even a million. We look at the average average volume is actually showing 5 point, basically 5.5. I don't know. I think there is a mistake. Look, no, I wouldn't trust this number. Like looking at this graph, you definitely see we're at 5 million. So you see here, at the last trading session was around 360, but on average it's less than a million. That's a red flag. Then assets under management, 1.2 billion. So the lowest one we were seeing was around 40, 50 billion. This one is substantially less. So that's another red flag. Small amount for assets under management. And then the other thing, portfolio, some BMO assets management. It's a Bank of Montreal assets management incorporated. I don't know. I wouldn't trust these guys. So I'm just showing you example that I would exclude. I don't see the why I don't. But it doesn't show me the information about how much do they cost. So probably there is a way to check with the other, maybe on the internet and so on. But anyway, here it doesn't show. So I wouldn't red flag it because definitely we'll have access to that information. But already few red flags that I found for me enough to make a decision. But just to complete the cycle, let's go further. Look, analysis ratings. Remember, I didn't like threes and twos. So this one, almost all are ones. So that's another huge red flag. Performance may be good. I mean, so they will ask you, do you want 10% per year? Well, that's pretty good. 17, of course, is better, but still 10% is good. And we see these numbers, they're substantially less than what we got on the Woo. And comparing to peers, to alternatives, they always kind of much less than alternatives. So that's another red flag. Holdings, oh, so Fortis Incorporated. I know this company, Canadian. I don't know, wouldn't trust considering the green so-called eco policy of Canada. It's crazy. Energy Corporation, BMO, Hydra One Limited, Verizon, AT&T. Well, no, these companies I wouldn't trust. So the industry allocation is almost more than half is the utilities, energy, and 21% technology. That's a lot, but this utilities, energy. Do you want to allocate into this side and the Canadian? The other thing is we are looking for U.S. equity, right? This is Canadian, half US mostly. No, another red flag. Dividends, another red flag. Look, 7%. I don't want this ETF ownership. We don't have it. So that's kind of another example of ETF that you don't want to check. So at the end, my overall and final decision, considering all these factors, I would say I would choose Wu. I will be researching more, but based on that information, that's all information that I've got, and comparing the alternatives, I think we did go through, where is it? Most of we considered VTI, Wu, this one, hard to pronounce, WAG. Okay, we can consider that one as well, but I think, yeah, I didn't check this one. I don't know, why not to check? Let's just do it. So we choose a ETF log, start seeing, okay, let's look at it, this assets under management, 170 enough. Spread, okay, spread. Now you start to see substantially much more, like 100 times, 10 times more than Wu alternative for SPY. The cost is 4 basis points, which is good. Okay, spread, and then wow, look, oh no, 400K, that's for the average volume less. So overall, just looking at these parameters, you can already make a decision. But if you want to go further, like trading tools, oh, get away from here. Should be open. Where? Oh, okay, it opened in the other monitor. Oh, oh, interesting. Okay. Average volume. Oh, kind of red flag a little bit, but the total assets pretty good management portfolio. Benchmark, another this again this benchmark that I didn't actually check. Expense ratio of 4 basis point. USA, Vanguard, management company, good analysis rating. Yeah, so that's kind of you start seeing threes and fours. Fours are okay, they're a little bit, but some a bit more threes. So start getting some red flag, especially comparing to the ones that we have. But again, like the performance is crazy. Would you go? That's up to you. And it looks like comparing to alternatives, it's all red. I don't know. I would still, even with this performance, I would still probably choose Woo, but I need to make a little bit more research and start considering like even companies like this. Look at the performance. Yeah, that's crazy. So this is the tools that I'm using, and right now picture is getting a little bit more clear for me. Now, like before, I didn't know. I like my mutual funds, but I want to get cheaper alternative. How cheaper? Instead of paying like 200 basis points, like right now, or in particular was 188, which means 1.88, which means 188 basis points. Now I'll be paying 3 or 4 basis points. Or if I go with SPY, I'll be just paying 9 basis points. So that's a lot of savings here, but of course I have to consider the performance as well, along with the other factors, because at the end of the day, performance is kind of what you earn, and that's the reason why you're doing this investments is to earn. So yeah, that's it. If you stay with me that long, that video took a lot. I didn't know actually. I was not expecting that it's going to take too long. Let me know. What do you think? Maybe you already knew all that information. It's like reinventing the bicycle, or maybe you found something useful. Maybe I should do this in a little bit different way. Okay, bye for now.